Venture capital is deeply misunderstood. Venture capital is part of an asset class that large-scale money managers have always managed, or at least since the 1980s. So venture capital, like real estate, private equity, private credit, debt, and what have you, I mentioned real estate, are asset classes that have different dynamics. Every asset class has a couple things. It has a risk-return profile. It has a return duration or threshold. It has the area and the country or the time in which it is more in season. So public markets, which are the stock exchanges and whatnot, the public markets, that is more of a focus during certain periods. Real estate, obviously. So each of those asset classes kind of rises and falls and has its own sort of cycle. But they're an asset class that are potential areas or strategies in which a money manager can direct capital. And the reason why venture capital, which is several $100 billion a year, is so important is because it tends to feed other asset classes like private equity and the public markets. So venture capital is the use of monies to further the definition and monetization and marketability of innovative technology. And so venture capital tends to be from the idea stage to the one in which a company might be going public. And so in our minds, we think of that from the seed stage all the way to a Series D, E, or what have you, into a company becoming a publicly traded, where it's available to the market. But the venture capitalists are these fund managers who decide which companies to invest in and nurture those relationships over time. In most cases, a venture capital cycle or a fund is managed by what is called a general partner. General partner is the manager of the fund, and they might have people like, they might have other partners, they might have associates and principals and people who work in the business to enable the identification and investment and supporting or nurturing harvesting of companies. General partners have limited partners, and limited partners are a group of investors who invest in that fund. So you might have a retirement fund limited partner. You might have a publicly traded company that is also a limited partner. You might have family offices or other businesses that are responsible for managing money at scale, often billions, invest tens of millions or hundreds of millions with that general partner into a fund. In most cases, a general partner is also a limited partner. So that means that a general partner has written a check to be an investor in his or her own fund. There can be a firm that has multiple general partners, but the way to think about it is a venture capital fund is tasked with finding companies that are early stage enough where they can get a large enough equity portion and they can watch that company become valuable over time. Venture capital funds are portfolios, so they have multiple different companies within that venture capital fund and within that venture capital firm. So a fund is a 10-year limited, thesis-driven in some cases, entity. And a firm, a venture firm, can have multiple different funds. And the life of those funds is usually around 10 years. 3 years that that venture firm is investing, and 7 years in which they're harvesting and supporting and ensuring the company's success. That is designed because that is often the life cycle of when a company goes from friends and family to institutional capital to some kind of exit event is like 7 to 10 years. So a fund will operate on that same cycle. The business model is pretty simple. Venture capitalists earn about 2% a year of their total fund value. Some firms earn 1, some earn 3. But 2% of, let's say, a $100 million fund is $2 million. So every year there's $2 million allocated that the investors have given the general partner $2 million a year to manage the fund. Hire people, legal, due diligence, rooftop parties, anything that needs to be done within the firm, that's the allocation from the investors. And then there's something called carried interest, or that is the 20% in the 2 and 20, which you might hear, which is the return in which the general partners are able to access. So if a fund has a $100 million, just using round numbers, return to the investors, that general partner, those VCs, will get 20% of the return above what they have contributed. So why do you care as an entrepreneur? You care because every time an investor writes a check, a venture investor writes a check, they are trying to return all the money that they took into that firm with each investment. So they have to believe that the amount of money they're investing in you at some point could give their investors back all their money. Whether they have 6 companies in their portfolio or 60, they want to believe that each of those companies has the ability to return the entire fund. And so that is the mindset of an investor. It sounds wild, but why you need to know is venture investors are typically, there are some exceptions, they're not interested in investing in companies that are going to stay small. They're going to be mom and pops. They're going to be lifestyle businesses. They want businesses that will eventually explode and be bought for tens or hundreds of millions or billions by a third party, or will be traded on the public markets and be something that is owned by millions of people. And so that is the very binary thinking of an investor, which is this going to be big? And so part of what you're doing as you're pitching an investor is you're making sure that whatever you're going after has that potential. And by the way, if VCs are good at one thing, it's sizing markets. So they know where to get the data to find out if this is going to be a small, incrementally growing company that requires a lot of capital, or something that needs a small infusion and will get significant returns. So as an entrepreneur, it is your job to understand not only, which VCs you want to take money from, but what asset class you really should be in. Should you be getting debt because your business has the ability to be profitable early and grow slow and incrementally? Should you be going to private equity, which is you've got a going concern that's got actual market penetration? Or is it an idea that has the potential to be massive and huge and worth tens of billions? So it's important for you to be honest about that, because one of the reasons why a lot of founders don't get funded, and this is the secret that we all talk about as VCs, is that the company or the market or the perspective is too small. One of the exercises that every founder and CEO must do, which is to size the market in which they're going after and do so with honest third-party data, and then to validate that so that A, you're not trying to raise venture capital for something that is ultimately going to be small. And why does that matter to you? At every stage of raising funds, you are risk adjusting your opportunity. And so in the beginning, you're giving away 15, 20, in some case 25% of your company at a round. And then by the D or whatever series, it's a lot less for a lot more capital. You got to make sure that your company is going to be a big concern, because if you're giving away so much of that pie, you want enough to be left for you and your other shareholders, which in many cases are your employees and your early investors. The VC business model is the one that most founders need to understand. Yeah. Is that we also have investors and we are also fiduciaries. One of the things that really worries me when I meet a lot of young founders is that they don't tend to see themselves in their venture investors. They think about this person as being all powerful. Well, we're fiduciaries as well. So we're fiduciaries to our investors. So having great information, trusting you is important, because we ultimately report back to someone else, right? And so we've got to trust that what you're saying is true. We've got to also be able to want to continue to believe in that. What's also important is a great relationship with your VC could mean a relationship with their LP. I've been in companies where I've raised money from my VC's investors. And that's important because they can write much larger checks than your VC can, because they're managing a much larger pie. And what the LP is thinking about, where the VC is thinking about massive return, the LP is the limited partner is thinking about avoiding risk and loss and getting consistent return over time. So it does flip between the LP and the VC, but in most cases it has to ladder up to being a great internal rate of return. I spent my whole career working with VCs, and I spent my career in rooms where there was never anyone who built a company. And so I wanted to get into venture capital for really two reasons, because I believe in my ability to mentor and help and support founders and CEOs. That's one. Two, I wanted to use the power of capital on some level back people that I didn't see getting capital when I was in Silicon Valley. I didn't see people over 40 getting capital. I didn't see women. I didn't see a lot of people of color. I didn't see LGBTQ. And so I wanted to put money into the hands of people who I thought would be great at driving returns.